Hello, everyone, and welcome back to the Security Token Insiders Interviews episode. I'm joined with Mark Yusko from Morgan Creek Capital. Mark, thank you so much for joining us today.
No, great to be with you again, and look forward to the conversation.
So we're talking about tokens, and I know that you've focused a lot. You've been spearheading this industry from the very beginning, and we've had a lot of conversations around security tokens as well as crypto and blockchain. Just let's kick it off with just starting with where are you looking right now? What gets you excited in the industry from blockchain in general?
We know it's really interesting. So this journey down the rabbit hole around blockchain technology and crypto more broadly really started back in 2013. And I wasn't as smart as the Winklevi and others to kind of really go heavy. I make the joke that I wasn't running drugs on Silk Road, not a cryptography student, didn't really get it. Although I did understand infrastructure. So I invested with my friend Dan Moorhead in some of his infrastructure funds, and that did well. But it was in 2017 where finally I broke down the resistance to our client base and around this idea that look, every stock, every bond, every currency, every commodity, every asset of value in the world was eventually going to be tokenized. And in fact, I came up with this hashtag on my Twitter stream, hashtag tokenize the world. And I just went back and looked before we got together here this morning. And I first tweeted it out right before I went on with Maria Bartiromo on her morning show back in early 2018. So March of 2018. And, tweeted a couple thousand times since. And I still believe that everything will eventually be tokenized. Now, we refer to those tokens a little differently now. Now we're everybody's talking about our NFTs or other forms of securitization on chain or whatever it is. But at the end of the day, what we're talking about is security tokens. I mean, tokens of assets. And I do think we had a little lull, and I think we're ramping back up, and I think we will see fantastic progress in that regard in the coming months and years.
Yeah, it's interesting. I mean, as we like to say, right, the crypto industry is really the wild, wild west in the sense that we're seeing that battle happening now between Gensler coming out talking about how most ICOs are securities, and then you've got the CFTC chairman who's coming out and saying, okay, well, ETH is not a security, and we stand by those statements that have been made in the past by former commissioners. And so there's really this battle between those pieces, which has really, I think, allowed crypto to thrive due to the fact that there really is not a lot of prosecution happening. And when it does happen, it tends to be settlements that are percentages of the revenue that's being generated by the business, which essentially is just kind of a line item for a lot of these companies. But it's been interesting to see with asset tokenization, specifically with real world assets, how there are so many established licenses in place and so much kind of established bureaucracy, especially here in the US, that has made it increasingly difficult, I think, for that innovation to necessarily thrive without the explicit permission of
Look, I like Jay Clayton's comment on this, and I will have to say that I think the SEC and CFTC and other regulatory bodies have actually done a pretty good job over the past 4 or 5 years. They haven't been brash. They've been very measured. They've been consistent. I like that. They've been very consistent. And I think they've prosecuted where there's been clear violation of security laws. And I think they've made some good decisions on kind of what is and what is not a security. I think maybe we need to update the Howey test from the 1930s. But that aside, I do think it's been pretty good. And I like what Jay Clayton said about, look, we built a pretty good global financial system anchored on regulatory regime that we created here in the US. It's true, right? Trillions and trillions and trillions of dollars of value, and it works pretty well. And so the fact that there are certain licenses that you need, to transfer money across borders, that there are certain licenses you need to sell securities, that there are certain protocols you need to follow, not protocols like security protocols, but rules and regulations that you need to follow to do certain things in this world. And I think that's important. I think world without rules and without regulation is chaos. And now too many rules and regulations will stifle creativity and adoption and innovation, as you said. But I actually think so far it's been pretty well managed, and we've seen a good symbiotic relationship between the regulators and the innovators. And we've had good innovation, and I think we've had prudent regulation so far.
I agree with that. And it, especially with a lot of this technology, when you're looking at investment banking services, financial services, they're in the business of making money, right? So the more that you can streamline and create efficiencies in those processes that they do, the more likely you're going to see those things succeed. It's all about reducing the cost of capital, especially for if you're an issuer that's looking to raise capital for your business. Just considering, you know, the different options is going to be something very important for them. And that's where, you know, as Mike Cagney came out from Figure and estimated that I think it's 3 to 6% of savings from an issuer's perspective, or from a, you know, from a platform's perspective in settlement fees, from, you know, instant settlement through smart contracts for securities. That alone, when you're talking about trillions of dollars of transactions that happen from any of these processors or from any of these banks that are moving assets from, you know, different accounts through different banks.
Yeah, I mean,
like,
look,
it makes so much sense.
It makes perfect sense that as we migrate from the analog world, right, physical goods and services, right, the old days, you and I would meet under the buttonwood tree in New York City, and I would have a physical analog asset, a piece of paper, a piece of currency, and you would have a physical asset, a piece of paper, a stock certificate, and we would exchange them. We had to be physically proximate. We had to, you know, literally exchange. There was risk, right? We could get thumped on the head with a wrench on the way. If you've seen the movie Gangs in New York was not a really cool place to live in the 1860s, and a little dangerous. And, you know, you had weather problems and, you know, all kinds of, you know, mice could chew up the piece of paper. So we migrated to the electronic world. And today there's this thing, DTCC, that literally uses 400-year-old technology, a little physical piece of paper and file drawers, but issues QSIPs that you and I can trade electronically. So now we don't have to be physically proximate. We can be in different states. You can be in Florida. I can be in North Carolina. We can actually trade. Now, one of the challenges of that is somebody is still the quote unquote owner of that asset. You and I don't actually own the securities. We have an IOU from our brokerage firm, just like an IOU from our bank. When we put our money in the bank, it becomes the bank's money. And people forget about that. They're like, what do you mean? That's my money. Like, no, it's the bank's money, and you have an IOU, and it's enforceable in a court of law, but it only works if the bank doesn't go bust. If the bank goes bust, then you lose all your money. Oh, but I'm insured. Well, yes, so long as less than 3% of all the banks go bust at the same time, because that's the amount of money the FDIC actually has. So yes, it is, you know, very carefully balanced. It reminds me, you know, I live in North Carolina, and we had an ice storm a number of years ago. And I got the first glimpse of how close we are to the edge of chaos. So this ice storm basically shut down the city for a week. First couple of days, no big deal, right? Keep the house warm. You got firewood, you got some food in the refrigerator. By about the fourth day, you run out of firewood. So now it's tough to keep the house warm. And you're starting to run out of food. Can't drive to the store because there's no gas in the tank, and gas station's not open because the electricity's off. Can't actually go into the grocery store. I don't have a gun, so I can't go hunt, and everyone else is hunting, so you probably just shoot each other. And so you realize that about 7 days, you're starting to get pretty desperate. Now, fortunately, the power came back on, and no big deal. But, you know, just-in-time inventories and, you know, all of this supply chain issues, you know, we've seen that disrupted by COVID. But in the financial world, to your point, there are all these financial intermediaries. They've all loved the fact that they have a role in the settlement of transactions and the exchange of goods and services, and they take their cut. You know, the Medicis came up with, you know, dual entry accounting and said, oh, you know, in the old days, if I lent Kyle money, I wrote down Kyle owes me money, and you had to trust me that I wrote down the right amount. You're like, well, that sucks. I don't trust you. I'm going to write down my own amount. Now you're going to have a ledger and I'm going to have a ledger. So now dual entry accounting. Well, but what if you write down one number and I write down another number? Who's the arbiter? Oh, the Medici said, oh, we will be the arbiter, and we will, you know. we'll keep track of everything. And the banks have had a good run for 700 years. It's been an awesome run, middlemen taking a fee. But now with code, you and I don't need that, right? If I send you $1, I have to have a bank account, you have to have a bank account, and the bank charges the fee to make the wire. If I have a Bitcoin, I want to send it to you. I don't need a bank account. You don't need a bank account. The computing network decides, one, Mark has a Bitcoin. Two, he sent it to Kyle. And three, Kyle has it, and now it's immutable forever. That's pretty cool. And I borrowed this thing about another hashtag in code we trust. Think about when you get lost. You stop and ask directions? No. You look at Apple Maps or Google Maps, right? You trust the code more than you trust the person. Part of the problem living in the South, you stop and ask for directions, and the person will say, well, you go down to where the general store used to be, and you make a left, and you go where the old oak tree was. I'm like, I haven't lived here for 100 years. I don't know where those things are. So yeah, I digress.
I mean, that's a very interesting tangent because it can be related to the securities markets significantly. One of the biggest frustrations for me in banking is not only the cost, but the delays, right? They're capitalizing on the float by requiring a 3 to 5 day transfer fee for something that should be automatically updated.
Instantaneous settlement. And the banks are closed more hours than they're often. Securities markets are closed more often than they're open. And what if you and I want to trade on a Sunday? I mean, why should we not be able to do that?
Not only that, but then you have what we've seen in the some of these meme stocks this year, where it turns out that not only were we handling the float on behalf of our clients, but we were actually executing what should be illegal trades through naked shorting of the float up to 140% of outstanding shares. So not only are we taking the float and trying to capitalize on it, but then we're actually then committing again, it's technically.
Well, no, I mean, Kyle, look, it's interesting.
Really, this is how far we're going down this rabbit hole.
People actually believe things are free, right? You get what you pay for.
Right.
If something is free, you are the product, right? Facebook is free. No, it's not. It costs lots of money to have all those servers and all that tech and all those people. Who's paying for it? You are. I mean, now you're not paying for it directly, but your data is being monetized and people are paying ad revenue to get your eyeballs and your attention. And same thing in securities, right? I mean, this idea that it's free, like trading, it can't be free. It costs money to physically transfer shares, to electronically store them. So what's happening is they're taking your information and selling it. And to your point, maybe doing some things that you're probably not supposed to do to profit. When discount brokerage came out, right? The old days, you have Merrill Lynch or UBS cost you $50 to do a trade. Now you can do it for $8. Like, right. So you pay $8 commission. So you save $42 in commissions, but you pay an extra eighth or quarter or half before decimalization in execution. And so you lose $250 on the price of a $1,000 stock. So that's bad. I mean, and people just don't think about it that way. They don't see it, so it doesn't exist. And, closing your eyes because there's some monster in front of you doesn't make the monster go away. It's still gonna, it's like my favorite story about the ostrich, right? The ostrich sees the lion come out of the bush. He turns his back, lays his head on the ground, doesn't actually bury it in the sand. That's a wives' tale. Turns his back, pretends that the lion can't see it. The lion still eats the ostrich. The ostrich just doesn't see it happen. So the fact that you don't see it happening doesn't mean it doesn't exist.
Yeah, well, and on your point of paying for order flow, I don't know, maybe you know this, maybe the listeners don't, but the man who pioneered the idea of payment for order flow was Bernie Madoff. So I mean, that this is where we're coming from. Clearly he didn't have the best.
Yeah, Bernie was pretty good at I should say skirting the rules.
Yeah. So very interesting stuff. So that's where this I think is an interesting place to take the conversation. So crypto is fantastic because it allows for a lot of these things, and one of the best opportunities for Bitcoin and for a lot of these other technological innovations is that we've been able to say, fine. If the financial institutions don't want to embrace it, we don't need you, right? Like
Right.
fine. If you try to ban Bitcoin, go ahead. Like we'll still be fine without you.
Yep.
Look at China, for example, who's banned it how many times now, and every time they kind of fail at it. So with, with the securities though, we need some intermediary layers here. Like how does DeFi get layered into, a lot of these? How does tokenization really work in your eyes for how the securities markets are going to evolve?
Now, to your point, look, securities have a long history of regulation. Now, the fact that we're still using rules created in 1940, right? The 1940 Act, kind of weird. And that rule was created to respond to some bad stuff that was happening in the late 20s and our 30s.
Law
and so it's probably out of date, and we didn't have computers back then, and all kinds of reasons why it's probably not the best technology. But it's like the capital asset pricing model, right? 75-year-old technology, we all still use it and think about it, but the reality is volatility is not a good measure of risk. Markowitz himself said that you should think about semi-variance, downside volatility from the mean, not upside. So technology changes, regulations change, but we still are anchored to these older systems. Why? Well, because change happens glacially, because there's a lot of incumbents that have a lot to lose if they embrace new technology. And I use the example of television, right? When I was growing up, I would run home, right, to be in my chair in front of my TV tray at 8 o'clock on Tuesday night to watch Happy Days, right? ABC owned me, right? They owned my attention. They owned my lifestyle. I fit my life around their television schedule. They served me ads exclusively because I was watching their shows, and they owned it. So now they owned all the content. They owned my attention. How did they lose all of their market cap to Netflix? Because as an incumbent, they weren't willing to give up their ad-based revenue model to embrace a subscription streaming model that in the short run would have meant their profits would have gone down and investors would have freaked out. Instead of now people pay a higher multiple for streaming companies than they do media companies, but they weren't willing to give it up. And the same thing is true in every incumbency. And what do incumbents do? They use regulation to try to slow down the disruptive innovators that are trying to compete against them. So let's look at crypto. So the banks and the financial institutions can see the writing on the wall. Like, they've been under attack for years. No one gets their mortgage from the bank anymore. They get it from a lender, online lender or peer-to-peer. They don't go to the bank, right? In the old days, you went to the bank and the banker knew your name, they knew where you lived, they knew your kids, and they actually expected you to pay back the loan, principal and interest. Now you go online and you're nameless, faceless, and banks.
All right, so we're back for part two. We had some technical difficulties there, but Mark, we were all captivated. We were talking about insurance and how lending works, and before it was kind of about, it was banks, and that was who we were really interfacing with. Now it's more of this kind of third party or outside vendor that maybe is using some of your data, some of these pieces. I was interested in hearing the rest of your point, if you remember where you were going.
I mean, I think that the key point there is that look, things change, and the traditional banking model has been under attack for decades, and fintech, financial technology, was the first wave of innovation, and the banks tried to combat that with things like net neutrality and trying to change people's access to the internet, and it didn't work, right? I mean, when you try to restrict people's free and open access to innovation, it backfires. But incumbents will always do that, and they've always done it. One of my favorites is the turn of the century when the horseless carriage came to be. The street sweepers in New York passed out pamphlets saying that if you got in a horseless carriage, you die. Well, yeah, maybe, I guess, if it turned over and rolled down a hill or whatever, but that could happen in a horse-drawn carriage, or it could happen on a bicycle, or if you fell off a scaffolding or whatever. But so they didn't want you to get in a horseless carriage because then they'd lose their job. And the bankers don't want you to transact in a more cost efficient, more effective, cheaper way because they're very happy being rent seekers. And incumbents will
losing, right? If you
always
cut out a middleman, someone has to lose there. So
someone
that
has
guy
to
isn't going to
lose,
support.
right? And what's really funny though about that is you actually don't lose. We have more jobs today than any time in history, right? Full stop. More jobs in the world than any time in history. Because yes, certain jobs get lost, but new jobs get created through innovation. How many million people work at Amazon? That company didn't exist 24 years ago. It was a joke, right? Jeff Bezos was on the cover of Business Week in 2007 when he talked about AWS saying, hey, Jeff, go mind the store and go sell your little books. No, I mean, he literally changed the face of commerce. And so innovators have this dilemma that they will be fought against. And the better the innovation, the more harsh the fight. In fact, that's how you judge the quality of an idea, is you look at the quality of the detractors, right? If a bunch of no-name people think you have a bad idea, probably doesn't matter. If presidents of corporations and central bankers and literally presidents of countries say that's a stupid idea, you're probably onto something. So, cryptocurrency is a better form of currency. Now, why do I say that? Well, if you think about it, money, right? Money is a very scarce asset. The only money in the world is gold. Everything else is credit. And what do I mean by that? Money is an asset that exists in the absence of an associated liability. Everything else is credit. It's a currency, but that currency is backed by government debt. It's no longer backed by gold or silver. Right? The pound note used to mean you could exchange the pound note for a pound of sterling silver. It's now worth 99% less than that in terms of that physical piece of paper, because we print more pieces of paper. We actually don't print them like the old ways on a printing press. We push a button and we get more ones and zeros in the system. But when an asset becomes less scarce, it becomes less valuable. So the huge innovation around blockchain technology, cryptocurrency, Bitcoin, et cetera, is we now can create digitally scarce assets for the first time. And that in and of itself has tremendous value, right? If we can create a token of some asset of value, and it can be unique and not duplicable, not reprintable, like the Mona Lisa, right? There is one Mona Lisa. Now, there are a lot of people that have pictures of the Mona Lisa, but they're not valuable. They may give you pleasure that you see it on your wall or whatever. It's a print or whatever. And, but it's not the original. The original has value. Now we can have digital assets in the digital world. Remember, we went from the analog world where you and I had to be physically proximate to exchange to the electronic world where we now exchange ones and zeros on a screen, to now the digital age where all assets and all ownership of assets becomes hard-coded in public ledgers. No more secret Mark's book or secret Kyle's book or the bank, the Medici saying, well, which book? It's our books. Now we have triple entry accounting, this massive global supercomputer that accounts publicly and openly for all ownership, all securities, all actions, all transactions, all insurance, all interaction between humans can now be recorded permanently and indelibly and unalterably. That's even a word. And it's just awesome. It's just awesome.
Totally agree. And so maybe a slight pivot, but I think that a question that I have on my mind is, through Morgan Creek, you've certainly made plenty of investments in equities, right? You've invested in companies. Yep. And now it sounds like you've fully gone down the rabbit hole of crypto and all this stuff, right? And so what we're seeing these days in the age of decentralized autonomous organizations, DAOs, or a lot of these different protocol platforms, there's an argument that governance tokens or some of these assets that don't represent the underlying platform or protocol being built are an acceptable substitute from an investor's perspective for the revenue generated or for the equity that's been created by the protocol. How do you feel about that argument? Where do you see the future going from an investment perspective?
Oh, I love it. I mean, I think we're just at the knee of the curve of adoption into Web3. And the way to think about this, think of an XY axis, think about a parabola. The left-hand side is Web 1.0, the area under the curve parallel to the x-axis. It's a decent amount of wealth, right? That's Cisco and Microsoft and Intel, decent amount of wealth. Now, as you get to the knee of the curve, that's Web 2.0. And that's companies like Alibaba and Facebook and Netflix and Apple, more wealth, way more wealth than Web 1.0. Now we're going parallel to the y-axis. That's Web 3. And DAOs and all of the decentralized applications. And as we go from traditional financial services to CeFi, that's TradFi, to CeFi, centralized financial services like Coinbase or BlockFi, to decentralized financial services, which is open architecture, smart contracts. The opportunity set is really endless. And so that upward sloping parabola starts to get really, really steep. And the opportunity set is so vast. And what we've done really at Morgan Creek, and it's funny, as in prepping for this, I said I went back and I looked for the first time I used that hashtag tokenize the world. And it was on TV with Maria. And what I actually said, it's funny, I saw a clip that Pomp had tweeted out that showed me saying, I said that, my plan over the next couple decades is to tokenize the world. And Maria said, you start to sound like Jack Dorsey. I'm like, that's the only time in my life I will ever be compared to Jack Dorsey. He's cool, I'm not. He's rich, I'm not. And look, I'm rich in many ways, but I'm not a multi-billionaire like him. But the thing about it was, that was my plan. And it still is my plan. And what's interesting about it is we launched a fund 3 months later in June of that year, Morgan Creek Digital Fund 1. And about 70% of that got invested in equity in companies, traditional companies like BlockFi and Figure and companies we talked about, Coinbase, and eToro and a few others, Bitwise. And then 30% of the fund, actually 20% of the fund was invested in liquid protocols themselves, Bitcoin, Ethereum, and we viewed those as investments in venture capital companies. Fast forward 2 years later, we raised Fund 2, did the same thing, about a 70-30 split this time from 80-20, and invested in Bitcoin, Ethereum, and this little thing called the Graph that's turned out pretty nicely in the DeFi space. And in Fund 3, which we're raising now, again, a 70-30 split, will invest in these new means of ownership, which will be DAOs, decentralized autonomous organizations, and other forms of ownership in the DeFi world, in the NFT world, in the the further applications of the metaverse. And we used to have the metaverse and the universe were like this. And there's a famous story of how Tim Draper bought all the Bitcoin from Silk Road. His client son was telling him he wanted a sword. And the guy's like, you can't have a sword. Your mom's not gonna let you have a sword. He's like, no, Dad, not a real sword. I want a sword for my game. I need $40. And the dad's like, no, you're not getting $40 to buy a sword. And Tim's like, aha, eureka moment. Wait, you're gonna convert real fiat money into digital currency? I gotta get some of that. So he did his research. He went out and he bought all the Bitcoins that were being auctioned off by the feds and made a couple $1 billion. So that idea that the metaverse and the universe are now overlapping, and people talk about, I'm in this DAO actually for creating the first DAO around fantasy football, and it's gonna be really cool. And one of the guys was like, yeah, when I win, I'm gonna buy real estate. And it's like, well, but am I gonna buy physical real estate or virtual real estate? I don't know. And people are buying the punks, and you just saw Visa buy a punk, and look, this is all here to stay. The genie's not going back in the bottle. The technology is not going away. We are going to merge ever closer between the metaverse and the universe. We all live digitally, virtually. You and I are talking virtually as right now. We exist both in the real world and the virtual world. We have assets in the virtual world. We have identity in the virtual world. And all of this is going to get increasingly complex and will be governed by this technology, by this cryptographically secure technology, be governed by different technologies. And so I don't want to bet on any just one. I want to bet them all. I want to own little pieces of all of them. Now, on the monetary side, I think Bitcoin is the winner. I think it's the best form of digital gold, right? I said gold is money, everything else is credit. Fiat currencies all go to zero, right? Every fiat currency in the history of mankind has eventually gone to zero. They all will go to zero because governments will always overspend. All empires will overspend. All empires fall, right? Ottoman Empire, British Empire, Roman Empire, they all fell. American Empire falling. All empires fall because politicians overspend, and that's not going to change. So if you think about where we are in that transition, the Chinese are ascendant, right? They're playing a different game. They're going to be the first to have a digital central bank currency that will allow them to have more control of global transactions. The dollar has been the hegemonic currency for 70 plus years. That's changing. After that, right? After the renminbi, I think likely we end up with a Bitcoin standard around the world. Why Bitcoin? Why not, right? It was first, it's best. And in an open source world, any improvement can just be copy pasted onto that chain and make it better. So it's unlikely we're going to have something superior because it's such an elegantly simple solution. And ultimately, currencies function because of belief and custom. And there are enough people that believe in Bitcoin as a monetary asset, and it exists like gold in the absence of a liability. And it has a fixed finite supply, therefore it's more scarce. Therefore, when you look at stock to flow and all those other models, it has this embedded inherent kind of number go up as if you have a fixed supply of an asset and rising demand, the price must rise. That's just supply, economics 101.
Well, that's fantastic, and we're nearing up on the end of our scheduled time here. We could talk about this stuff all day for sure.
Absolutely, and I talk too much, and I apologize. But
maybe there's two questions. The first one that I have that is to follow up on your last point before I kind of wrangle it back to close it out is you mentioned empires, right? You were talking about a bunch of different empires. What is the empire that is built in a decentralized world? What will that empire be? Because that's
awesome.
a fun conversation to have.
Now, it's an awesome question, one we could talk a lot about because there's a philosophical angle to it. And it's in essence, it's the anti-empire, right? It's the sovereign individual as opposed to the sovereign empire. And one of the most amazing things about cryptographic security, about digital scarcity, is this idea that we can have sovereignty, we can have personal freedom, and we can opt out of the foolishness of centralized governments. And look, it doesn't mean I'm going to give up my citizenship and go live on an island somewhere. I enjoy, at least for now, living in the United States, although they're making it harder every day. And I will spend in fiat. So I will, convert some of my resources into fiat so that I can live my life. But that doesn't mean I won't opt out for a portion of my wealth into digital assets such that I can have a secure savings technology that is discrete from and not subject to the whims of central bankers. So as we think about a borderless world, right, a metaverse where literally borders start to erode, where are you a citizen of? You're a citizen of the world, of the metaverse. So that starts to be kind of mind-bending. What does it mean for the next empire? Well, I do think it is the collective intelligence of sovereign individuals, the DAO-like governance of these autonomous organizations. And there are defects to that, right? I mean, is the majority always right? Not always, not always. And is it possible that you could get manipulation in some of those systems? People worry about miners and things like that if it gets too concentrated or consolidated. Could you have a DAO that really wasn't truly autonomous, that really was controlled by a small group of powerful individuals? Sure. So I think time will tell how this evolves, but I think the idea of nation states becomes less important. I think the idea of centralized systems becomes less important. I think the idea, it's interesting. If you go back in history, the world reserve currency was owned by the country with the fastest ships, right? Until recently, I believe, that China figured out that the next war is going to be fought with chips, not ships. And so they are dominant in things like cyber.
That, right? We have a global shortage of chips because
exactly, because they want them all. And there's a reason that they're controlling them. And the more cyber power you have, the more control of digital networks and digital assets you have, the higher you are in the hierarchy. And so I do think that is a transitional step in between the old school, think of it like TradFi, CFi, DeFi. My dad, 83 years old, never going DeFi. He's never going to hold his keys because then he doesn't own his Bitcoin. He's perfectly comfortable for Coinbase or BlockFi to hold his Bitcoin. He has that account. He trusts them, and that's fine. Could you get rug pulled from a centralized organization? Sure, you could once, but there's no incentive for them to do that. They're very profitable.
You could get bank run. Sure, that's probably
kind of a bank run. Yeah. Could the bank abscond with all your money? Yes. Does it happen very often? No. Is there a risk? Look,
BlockFi's rates have definitely not made everybody happy with the constantly decreasing rates.
Yeah, I mean, look, the reality is organizations that are centralized are appealing to a certain type of individual, right? An individual that's comfortable with the idea, but not with the technology, with the UX.
Right.
And there are digital natives like yourself and others who, and people get mad when I talk about this. It's not just young people, some of us old people. I'm like, fine. There are some older people who are comfortable with the digital experience as well. But if you ask the average person over 35, who's your broker? UBS, Merrill Lynch. How much gold do you have? 3 or 4%. How much Bitcoin do you have? Oh, are you kidding me? It's a Ponzi scheme. 0. Ask anyone under 35, who's your broker? What's a broker? You mean my Robinhood account? I got that. Yeah. How much gold do you have? Oh, are you kidding me? Boomer rocks? 0. How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really big percentage of my net worth and I'm embarrassed. So that doesn't mean there aren't 50-year-olds who have a lot of Bitcoin. It doesn't mean there are 35-year-olds who own gold. They do exist, but they're not the norm. And the exception proves the rule. There is this digital divide. Digital natives are not going to own boomer rocks and boomer corporations. They're going to own DAOs. They're going to own digital assets. They're going to live in the metaverse, and they're going to have identities that are maybe linked to to CryptoPunks.
Interesting.
And again, conversation for another day, but it's a long-winded way of saying the world is changing. The power structures are changing. How we live and interact in that world is changing. I think it's all for the good. Will there be challenges along the way? Of course. Do security tokens solve everything? No. Do they solve a lot of things? Yep. Do they take out a lot of costs and waste? The WEF says it's $7 trillion of waste that goes to middlemen that don't need to get paid. Yep. Could we use that $7 trillion for more creativity, more innovation, and more wealth creation? Yep. Will technologies that we just talked about over the last 45 minutes enable that? Yep. Am I excited to be part of it? Yep. So
that's awesome. That's awesome. My final question is just to wrap that together, and you hinted at it there, and not to hold you for too much longer. But what does an industry like the security token industry, which is kind of still centralized to a lot of the degree, right? We're trying to appease with a lot of these brokers and bankers and trying to at least extend the olive branch of trying to figure out how some of the traditional financial pieces can be replicated in something like the metaverse or in this kind of blockchain-based angle, which I personally believe is going to be very important. I think that underwriting from banks is something that companies need. I think that insurance providing and a lot of these opportunities for scale of financial services, there is some degree in which that can be incredibly valuable. And so a lot of my peers might suggest that they don't need them at all, when I think that maybe there's probably a way that everybody can play together.
No, look, you're right.
How do we make that happen? Like how is it as an industry that's already kind of to some degree behind the 8 ball because it's still focused on that other side, but is trying to upgrade for the future. You know, what would get you excited or really interested in the security token space in the same way that your eyes light up when you talk about the metaverse?
Look, I am excited about security tokens. The challenge is incumbency. The incumbents have so much to lose, and what it will take is a Netflix-esque kind of upstart that will gain enough critical mass to start that snowball rolling down the hill. And once it starts, you can't stop it. And so now it could be from within, right? You could have one of the big banks finally just throw their hands up and say, yep, we're going to do this. That could happen. The problem is networks are hard to recreate, right? You know, Goldman Sachs worked really, really hard over decades and decades to build the capital markets network that they have today so they can snap their fingers and raise $1 billion. If you and I went to do a security token offering, it's hard to raise $1 billion, right? Because we don't know that many people that have that much money. We know some, but you need that intersection of the new idea and those old networks. And either parts of them will hive off, right, and start the new stuff. That's starting to happen. You're seeing that people leave. You know, the talent migration right now that's happening is the greatest I've ever seen other than the internet in the 90s. So that's part of the way it'll happen. The second is somebody, you know, one of the big shops I think will either through a transition of leadership, right? Old leaders, they're not going to do it. It's like going to DC. I took my son and my parents to DC this past weekend. A bunch of octogenarians are not, septuagenarians and octogenarians are not going to make innovative rule changes. They're just not, right? It's not they're not good people. They're perfectly nice people, maybe, but they're not going to make those types of changes. We need some of the young. Now, we don't need just the young, crazy extremists. We need some young, idealistic, logical, and maybe some middle ground, maybe some 40 and 50 somethings who have some experience and some knowledge and some tact to achieve that middle path, because the middle path is always the right path. The extremes are always dangerous. The middle path is where we need. So I think we need good leadership. I think you'll see that. You'll see there's some financial services institution. Maybe it's Mike Cagney. Maybe what he's doing at Figure can completely disrupt DTCC. Maybe it's Zach, who's one of the great founders at BlockFi, and Flori's just as good. She's fantastic. Maybe it's the Winklevi, at Gemini. Maybe they have the star power to really push this adoption. So it's leadership. But all the problem is they're still young and they're still learning and they're still growing. And some of the old guard. And I'm trying to sit in the middle. I'm trying to straddle me and Dan Moorhead and others like us. We've got the white. Well, Dan doesn't have white hair, but I have the white hair to kind of be that middle person in between, kind of pulling both sides toward the middle. So yeah, maybe it's one of them, or maybe it's us here at Security Token Market, but that's maybe a conversation. There you go.
Mark, thank you so much for joining us again. And hopefully we'll be able to talk soon.
All right. Well, again, I do think it is likely to be people like yourself who are bold, innovative, highly energized, and have been early and I think consistent in your just dogged determination to bring this to fruition. And I applaud all your efforts and everything you're trying to do, and glad to be part of it.
Thank you for everybody tuning in. Please reach out to Mark, let him know any of your questions or tell him that you enjoyed. And he's very, very active and is always responsive. So thanks a lot for that, Mark. We appreciate it. And we'll talk to you sometime soon.